Hello everyone, let us continue with our discussion. In the previous lecture, I have discussed about the capital market framework. We have to forecast the expectation or the expected return in the future, the problems in the forecasting. Apart from that, we have moved ahead with the growth return. Okay, how much growth is expected, exogenous shocks, okay, how it can impact my growth, because growth is a very important factor when you are forecasting something. Clear? Now we are moving towards the market forecasting. Now the author is taking you towards the economics. So from here onwards, when we are moving ahead to all the topics in this particular chapter, they all are somewhere related to the economics, and most of the stuff you have already covered up before. So I am trying to stick to those areas which are new, and the one which are you have studied before, I'm going to touch upon that so that it will feel like a revision, so that we can save on our time. Clear? So now when you have to forecast, okay, when I am saying that my focus is economic forecasting. So what, first of all, what is the meaning of the term economic forecasting? Write the word economic forecasting. What is this economic forecasting? It's like how economists try to predict the future of the economy, just like the weather scientists, they predict the weather. Clear? So now I have three major methods for that, or you can say I have three different approach. One approach is econometric modeling. This is the first approach, econometric modeling. Clear? Then we have another model is economic indicators. Then coming to the third one is checklist approach. So I have three different approach: checklist approach, economic indicator, and econometric modeling. Sir, what is this econometric modeling? What you can do is, I have given these notes to you. Okay, these notes are uploaded in your portal. You can just download them, take the printout if you wish to, and you can write down few of these key things on this paper itself, or else you can prepare your own notes side by side. So both are completely fine. Clear? Econometric modeling means statistical models. Statistical models. Clear? So when I'm using the word econometric modeling and now I've used another word statistics, now it means that I include the math, I will include the statistics. Now statistics is not possible without the past data, so I am also including the past data. So econometric model include your maths, your statistics, and also your past data. Clear? With the help of all these three information, we are going to create the econometric modeling or statistical model to predict the future of the economic values. Like if I want to predict the India's future GDP, clear? So what I'll use the past consumption data. I will use the data with respect to the past investments, interest rate data, inflation data, as well as the data with respect to the export. So combining all this, what I'll do, I'll predict the India's future. Now suppose I'll give you one more example. Suppose you run a shop. Okay, so what you will do, if you want to order, suppose Diwali is about to come. Clear? Now you want to order the goods which you will sell. So what you will do, how much you should order, what data you will use to identify that how much to order now. Last year Diwali sales, this year footfall, till now how much it is, increasing pattern, decreasing pattern, customer spending pattern. Clear? Customers preference. So based on this, you will predict that how much stock you should order. Clear? So this is exactly what econometric models do. Clear? But the question is, sir, what are the advantages of these models and what are the disadvantages? So when I'm saying advantages means it can include many variables, it can include many data points, Clear? Now once you have designed the model, you can use again and again. The same model can be used again and again. Are you clear? So it's like you have created it once, you have tested it, now you can use it multiple times, you can use it every year. Clear? Now, the third advantage is output is numerical, but it should look scientific. It should make sense. So that is possible through your econometric model. Now, there are some disadvantages as well. What is the disadvantages? Sir, it is complex, very hard to design. Clear? Very time consuming. Also, costly. Something which is complex and time consuming, it is costly as well. Clear? Then hard to forecast the turning points. Basically, relationship between the variables. Okay, they change over time. So how you will put that relationship on a regular interval? You have to change it on a regular interval, and sometimes it's hard to identify that yes, the relationship between the two intervals have actually changed. Clear? Sometimes the models are often they fail at the turning point, like predicting a recession. Means suppose you are standing over here, every year you have predicted the GDP properly, 5%, 6%, 7%, 8%. It looks nice, it's stable, 9, 9.1, 9.2, stable. It's very hard to predict that recession is coming through these models. Clear? So you fail at these turning points, which is very crucial. So these models are useful. Definitely, you can use multiple data points. You can use it again and again. Output is numerical. It looks scientific, but the most important factor, costly. Relationship can change between the variables, and the turning points are very difficult, very hard to analyze. Are you clear? Like, I'll give you one example. Before the 2008 financial crisis, okay, most of the models have failed to give us the signal that there is an issue. Recession is going to come. Market failure is going to come. It was not informed by any models. Clear? Now, coming to the second approach, that is economic indicator. Basically, what was the problem in the previous model? Sir, it's very hard to identify the recessions. Means turning points are not easily visible. Clear? So, with this model, economic indicator, okay, write down the line, data that moves before, comma, with, comma, or after the economy. Clear? So you have three different types of indicators. One which is actually moving before the economy moves, or after the economy moves, or side by side. Are you clear? So indicators are like the signals. It will give you the signal recession is going to come. Sometimes these signals will come after the recession will come. Sometimes these signals will come before the recession will come. Both after and with. Clear? So now we have three different types of indicators. Okay. We have mentioned it over here as well. Okay. Number one is your leading indicator. First one is your leading indicator. Second is your coincident indicator. And third one is your lagging indicator. Clear? Now, basically, these informations are generally provided by the governments, OECDs, or some private bodies like the conference boards or something like that. So they will give you these informations. Now, when I'm talking about the leading indicators, they move before the economy will move, like stock market, some new business orders, consumer confidence index. So they will tell us what is going to happen next. Stock market, because if you know that something is going to happen, it will be shown in your stock market on a very short notice. You will see the impact in the stock market. If new business orders are not coming, you are going towards the recession. If new business orders are huge, you are going towards the boom. Consumer confidence intervals, they will tell you that how much they are confident. Your employment rates, your interest rate, they will tell you that yes, how from where we are actually moving towards. Clear? So leading indicators actually helps us in predicting the future. They move ahead of the economy. They will tell us what will happen next. Like if you see many new buildings are being constructed, so it indicates that the city's economy may improve in the coming year. That's a positive sign. Second is your coincident indicators which are moving with the economy like GDP, employments or retail sale, because GDP will come after a point of time, after quarter and quarter. So if GDP is falling, so they are moving with the economy. Employment is falling, moving with the economy. Retail sales is falling, moving with the economy. So they will tell us what is happening right now. Clear? So coincident confirms your current conditions. Clear? Lagging indicators, they move after the economy. They will confirm that yes, the trend which is currently happening with the GDP, with the employment rate, with the retail sales. Now if your unemployment rate is increasing, bank loan defaults are increasing, so they will confirm that yes, whatever was shown in your coincident indicators, they are correct. So they confirm your past trend, whether rising trend or falling trend. They confirm that yes, whatever you have understood over there, whatever you have seen over there, they are correct. Are you clear? Apart from that, we have two more index as well, like composite index and diffusion index. Composite index means what? It is a combination of several different indicators. So they will have all the information that what's happening. It includes your leading, it includes your coincident, it includes your lagging as well. And diffusion index means the number of indicators showing expansion, what is contraction. So there are multiple indicators inside this index. Some are for expansion, some are for contraction. So you will see which one is heavier, like just like a put call ratio. If it is higher, if put call ratio is higher, that means more and more people are betting that market will come down. If this is low, more and more people are betting that market will go up. Clear? So these are the index, they will tell you the whole story. Clear? Now this will also have its own advantages as well as disadvantages. So if you look at the first one, okay, simple and easy to understand, data is readily available and we can make our own indicator list. These all things are very easily possible. Now sometimes the results are inconsistent, means they will give you the false signal. Suppose it will give you the signal recession is going to come, you will sell all your stocks. But what if it's booming actually? Clear? Sometimes the data can get revised, creates confusion. Sometimes you cannot trust the data. Okay. And if you make huge revisions, then your model will not look good. Then you cannot trust your models too. Clear? Now coming to the third approach, that is your checklist approach. See over here, if I am an analyst, what I'll do, I will use my logic plus I will use my judgment to analyze the given situation. So what I'll do, I will review multiple questions, multiple data points. So I will create a checklist of the questions like what did the latest employment report says? Is the central bank increasing the interest rate? Are the business investing more? Based on the answers to this question, I'll analyze and I will give a forecast. Clear? So I will use my own judgment. Accordingly, I will create a forecast. Like imagine you know that whether your shop will do next month or not. So what you'll ask, are customers buying more? Yes. Okay, good. Festival season is coming. Answer is yes. Your sales will increase. Is your competition increasing? Yes. Possibility that my sales can also go down. So like this, I will create a checklist method and based on that, I will analyze what's going to move ahead. Clear? So now it's very easy to do, less complex than econometric. Clear? It is flexible. You can use statistics. You can use human judgment as well. Problem, so it is subjective. It can depend from person to person. It's very time consuming. Checklist, data, analyzing, and then taking the action. And it's very hard to manually analyze all the possible factors. So what you'll do, you restrict yourself in the number of factors which you are analyzing. Clear? So three approach to actually do the forecasting of the market. Clear? Coming to the second step, that is your business cycle. Now, another concept of economics is your business cycle, like how the economy moves in a phase. Okay, business cycle sometimes up, sometimes down. It's all because of your economic activity. Just like day and night keep repeating, similarly, economy also moves in a cycle. Clear? Now we have 5 phases of business cycle. Okay. Now, few of the key points which you can read from here. Number one is your long term. When I have a vision long term. Okay. So what I want the growth rate to dominate. The trend must dominate from the growth perspective. Clear? And in that situation, short term fluctuations hardly matters to me. Means, I'll give you one example. My business cycle going like this. Okay, something happens over here, but again something happens over here again. So now you see this short fluctuations are hardly relevant to me. I am focusing on the long term growth story. Clear? Sometimes you look for the short term as well. Okay, because they will provide you some useful signals. How strong these short term signals are. Because what can happen from here, after this short term shock, there is a possibility that even the trend can go downwards rather than going upside. So short term business shocks are also very important to be analyzed. Clear? It's very hard to separate the short term cycle from the long term trend changes. They are the part of the whole cycle. Means it cannot go up and up and up and up all the time. It's like up, down, but up more. It's like something like this. Up, down, but now up more. But now you went down, but you see, you're still above this. Up, down. You're above this. We call this as an uptrend. You're in the uptrend. Clear? Now, market return depends upon the real economy and what are the expectations of the investors. How they are presuming that market will move towards. So, if my expectation about the market is a growth story, so market will move there. But that needs to be backed by the real economy, that how your real economy is booming or not, production increasing or not, exports are increasing or not. Clear? Because just investor expectation will not leads to the growth. It needs to be backed by the real economy. Clear? Now coming to the 5 phases of the business cycle, we starts with the initial recovery, then we start early expansion, then the late expansion, then slow down, and then contraction. Means you slow down over here and then it's a recession. So these are the 5 phases. Clear? We start with the initial recovery. It will take few months time. This will take few months time. Clear? And this includes your confidence is rising, inflation is slowing down, government is cutting the interest rate, stock market started rising, risky assets are also performing well. Like after COVID lockdown, when businesses have reopened, so people started spending again. The economy started reviving. Clear? Now, apart from that, you will check few more points like government stimulus, low interest rates, deficits, are they decreasing or are they increasing? Large output gap. There is a gap between the demand versus supply. All these needs to be checked. Clear? So now you have seen the initial recovery based on all these information. Your next step is to think for the early expansions. Okay, like it will last several years. Okay, growth is rising, inflation is low, confidence is still rising, short term interest rate now decreasing. Clear? Short term interest rate decreasing because government is cutting your interest rates so that the economy can take the boost. Clear? Sorry, the long term rates are decreasing, but short term rates are increasing. Now I'll give you the reason why long term rates are decreasing, because the government is showing the confidence. Clear? but the short term interest rate is increasing. The reason is the demand for the money. Huge number of businesses are asking for the money. So what will happen when so much of people will ask for the money? The interest rate will increase because of the scarcity of the money. Clear? It's a law of demand. Clear? So short term interest rate will rise and output gap will start narrowing. The demand versus the supply, it's started shrinking. Bond yield either will become stable or will rise, and stock prices also rise. You will see that stock market is also booming. Now, final stage of expansion, very high confidence, very high employment rates, output gap eliminated, clear, inflation started increasing because now everyone will have the money, they will started purchasing the things, hence the price will start increasing. Now central bank will started tightening the money supply again because of the inflation. They want to control the inflation. Short term rates still rising, bond yields rising, stock price are high, but now it's volatile because now you see inflation is coming. Now the slowdown is coming. This will last few months or sometimes more than a year. Confidence started declining, inflation still rising, short term are at the peak. Now no one will start borrow. When no one will borrow, no production, recession. So next step is your recession. Clear? Bond yield, first of all they will go to the peak and then they will start falling. Clear? Stock prices also started falling. Then the last stage comes is a recession. It will last more than an year, sometimes 2 years as well. You have lost your confidence, lost your profits, no employment, bankruptcy crisis, inflation peaks, and now it started falling because no one have the money. Inflation will start falling, and hence you will started working towards the recovery again. Short term rates are now falling. No one is demanding for the money. Rates are falling. Bond yields are also falling. Stocks started rising before the recession ends because now they have to come towards the recovery. So this is a part of your business cycle. Clear? Now coming towards the inflation. You see, at every point we are discussing about the inflation. During the recession, inflation is at the peak and now it started falling. So gradually, once your economy is moving uptrend, your inflation is also moving, then stable, and then inflation is also coming down. Clear? Over here, inflation is booming, peak, recession, inflation will also come down. Clear? So now we have 3 points to discuss over here: inflation, disinflation, and deflation. What is inflation? Price rise. Clear? And it accelerates near the business cycle peak. Disinflation, inflation is rising but at a slower rate. It happens near the recession, over this point, near the recession. Deflation means prices have started declining. Clear? Very dangerous economic risk. You see over here, very rare chances, but if it is seen that prices have started declining, worst event for the market. Clear? Inflation rising, disinflation, rate will started falling down. Inflation is rising. Earlier it was rising at a say strike rate of 90%, but now it is rising at a strike rate of say 40%. So the speed of increase have reduced. Are you clear? These are the 3 terms: inflation, disinflation, and deflation. Clear? Now deflation is very risky. Over here, defaults will start increasing. Defaults will started increasing. Asset price will start fall because of the reduce in the equity. People don't have the money. So what will happen? Your assets are less than the liability, and hence assets value keep on falling because everyone tends to sell their assets, even whatever money they will get. Clear? Interest rate fall near to zero because central bank don't have the money. Okay, central bank will lose the rate cut power. What economies in the recession, central bank have the power that they will reduce the interest rate so that they will borrow and they will do the business, make the money, run the economy. But they will reach a situation where central bank can't even cut the rate because interest rate are close to zero. Clear? It leads to policies like large scale asset purchase. other countries, other banks will come and they will start protecting you. Clear? So the impact of inflation will come everywhere. Your cash, your bonds, your equity, as well as your real estate. Clear? Cash will lose the value when inflation is high. Clear? Because suppose before the inflation, rupees 10 can buy you one apple. Clear? After the recession, rupees 100 is buying the same apple. So now you see that value have reduced for the money. So money have lost its value. What will happen to the bonds? Because of the inflation, yield will rise, bond price will start falling. Clear? Equity, moderate inflation is okay, but high inflation reduces the margins as well as the valuations of the company. Same things will happen to the real estate. Okay, moderate inflation rises the rent and the prices of the lands, but high inflation will hurt the financing cost because the interest rate is rising. I have to buy a land. Earlier the interest rate was 7%, but now the interest rate is 17%. Do you think I can afford it? I cannot. Clear? So let us come to this point. When I am at the initial recovery, okay, my inflation initially is declining. Clear? Because from here I am trying to reach over here, so inflation is declining. Clear? When I am towards the early expansion, inflation is low but economic growth is really good. Clear? When I am towards the late expansion, inflation rate is increasing. Inflation rate is increasing. During the slowdown, it accelerates. Inflation rate accelerates. Clear? And over here, inflation will peak. During the recession, your inflation rate will peak. Clear? Okay, so I'll keep this much in this lecture, and more points I see with respect to your monetary policy and fiscal policy. Again, to another concepts of the economy, and very intuitive, means everything we have covered it before, so it won't take much time before we end the topic. So in the next lecture itself, I will finish your topic. Clear? So I'm ending this lecture here. Thank you.